The Swiss franc is at a new more than decade high today when it shouldn't be anywhere close. And it should go without saying, this is not a good sign. The latest bank data from the Treasury Department helps us understand why the franc is not backing down, even after the Swiss National Bank went full ZIRP, or zero interest rate policy, last week. What we're seeing is a monetary system that's on edge over a potential repeat of April, especially now that we know what actually happened in April. And yes, I'm talking about shadow banks. We've been warning about the exposure between regulated banks and so-called shadow banks for over a year. Even regulators, they've been pointing out the high degree of close connections between the two. And those connections were pulled extremely tight 2 months ago and then very nearly boiled over. This is why the franc won't back down, nor other key measures like dollar swap spreads. They remain at extreme levels, and macro risk, regular macro risk, doesn't fully cover it. While the economy is in increasingly obvious trouble, so obvious even central bankers are ditching their inflation narrative and posturing, there has to be more to these monetary warnings. That's why central bankers are rushing to the race to the bottom, because all of these signals are lining up in the wrong direction, not just in macro, but more so here in money. And the franc, that's one of the biggest of all of them. The shadow bank connection is no longer some down-the-road theoretical prospect or risk. It has happened. It has been road tested in April. And now with the latest data that we have, it shows it came within a whisker of really going over the edge. And that has the monetary system on edge despite all the re-risking euphoria that you see in the stock market. That's why the franc hasn't budged, swap spreads have gone nowhere, and the monetary system looks as much today like it did in April as far as risk-taking and really risk aversion. And you'd think with oil prices that are now crashing after the ceasefire between Iran and Israel in the Middle East, that the franc itself would be going in the same direction as oil, that it would be coming back down as the worldwide monetary system relaxes its posture. But oil prices are sinking because fundamentals in the global economy are beginning to reassert themselves after the geopolitical risks diminish greatly. We see oil prices that are down back around $65 per barrel. And even though the status of the ceasefire isn't fully clear this morning, the oil market no longer cares. It's a good bet that whatever happens, there's not going to be some huge threat to oil infrastructure or the Straits of Hormuz. Therefore, oil can go back to pricing more exclusively fundamentals, which remain decisively ugly. You take away those geopolitical risks, and what's left is not $80 or even $70 oil. It might not even be $60 oil. That's why prices have been slammed so much all at once. But for the Swiss franc, if there isn't a lot of war risk in oil, why is the franc soaring again? Why is it hitting its highest level since 2011? Right now, the franc is at 0.804 and even 0.803, which if it holds that way, that's going to be a new more than decade high. So it's flight to safety, but it's not flight to safety from the Middle East. This is the economy. This is financial risk. This is even money and banking, the aftermath of April. Look at the franc's recent history. It absolutely surged during the April deflation and liquidations, but then it kept going all the way until late April. And then after that, it only retraced a small amount to roughly 0.85 by mid-May. And then since mid-May, it's been strengthening again almost in a straight line. Now, as I talked about last week with the reintroduction of zero interest rates, there's zero interest rate policy from the Swiss National Bank, a lot of that has to do with policymakers at the bank trying to arrest the strength in the franc. They want to counteract the franc's rise and try to get it to go back down all over again, thinking that price stability in Switzerland is best accomplished by some form or some degree of stability in the currency exchange value. But the currency exchange value is not within the grasp of the Swiss National Bank, certainly not in times like these, deflationary circumstances, risk off and risk aversion. The franc will strengthen regardless of what the Swiss National Bank has been doing, which is why it hasn't worked. The S&B has been cutting rates since last March, and over the last 6 months, the Swiss franc has gotten stronger and stronger and stronger. Not only is the S&B down at zero trying to counteract the franc, we also have to keep in mind that Swiss bond yields are already negative, yet the entire global monetary system, these global banks, They're choosing to park spare funds in Switzerland anyway, even as it's yielding negative returns. That's how strong this worldwide safety and liquidity concern has to be. And while Switzerland is a relatively small country and economy, its banking sector is still large and important. Therefore, the strength in the franc is the entire Eurodollar system on edge over something serious. It's not World War III. That's being settled. At least that risk is being taken off the table. It's not inflation, certainly. It is something else, and I believe it goes beyond just regular macro risk. But as far as the macro risks go, we've got dovish central bankers everywhere that are confirming, at the very least, the macro direction isn't inflationary. And if it's not inflationary, that means the other side of the equation, which is employment concerns, downturns, maybe even worldwide, full-on, recognizable, understood, and confirmed recession. I mean, just look at the Fed dots last week. They didn't even last 2 days. After being released on Wednesday, by Friday, Fed Governor Christopher Waller was saying, yep, I support a July rate cut. And if they do a July rate cut, it's not going to be just July. There's going to be a series of them afterward. And then on Monday, yesterday, he was joined by Federal Reserve Vice Chairman Michelle Bowman. And both of them conveyed their growing concerns over weakness that's already apparent in jobs and employment. They see the downside in the economy in the United States as much as other central banks around the world see the downside in their local jurisdictions. Sweden, the Riksbank, they already fell to 2% and said, we're going to go lower, even though back in January they said they were as low as they were going to go this cycle. That's the point. These central banks say they're done or they're not going to do it and end up having to do it anyway because the macro environment is not responding to lower interest rates, and the fundamentals argue for more worsening conditions and downturn ahead. Even Norway's central bank, Norges Bank, they cut for the first time since 2020, and they said, too, there's more to come because they don't see any inflation risk. And on we go. The Bank of England, the Swiss National Bank, the aforementioned ZERP policy, and the very big likelihood that the Swiss are going to have to go to negative interest rates or NERP just to counteract the strength in the franc, which just goes to show the strengthening in the franc, which is responding to global consideration, global concerns, worldwide monetary conditions and risk aversion, which means that in this case, quite literally, central bank policy is a reaction to conditions around the rest of the world. For Switzerland, it's not about Switzerland. It's about why we have this tremendous, steady, safety, liquidity bid from a major outlet and a major part of the Eurodollar system. What is continuing to keep the monetary system on edge? It's almost the 4th of July, and you know what that means. Eurodollar University's anniversary, our 3rd anniversary. We're going to have a webinar. We're going to have a sale on all our products. Plus, we're going to launch another subscription service. And I'll give you all the details as we get closer to the 1st and 2nd weeks of July. Eurodollar University anniversary sale webinar. Check out our website for all of the details behind those. I hope to see you there. So while there's this growing downside in the U.S. economy, as well as the rest of the world too, that doesn't explain the persistent strength in the one-way direction for something like the Swiss franc or these other extreme measures I keep pointing to, like swap spreads. There's more than just a downturn finally reaching the stage where we get layoffs across the global economy. It goes beyond that. It goes back to April. Because the Swiss franc is so heavily embedded, as the Switzerland and its banks are, in the Eurodollar system, there almost has to be a monetary angle in the Swiss franc's strength. That's why we see the Swiss franc's true strength like we do during these periods when there's real duress across the entire Eurodollar system. And let's face it, the memory of what happened in April, which was a substantial event, a substantial deflationary event, is still fresh in everyone's memory. It didn't just come and go magically fixed by the announcement of delayed tariffs like the stock market is thinking. That memory is a key reason why the franc didn't retrace as much since April, same with all these other indications. So what is the bank data and what does it show? Well, the bank statistics come from the Treasury Department, the Treasury International Capital Report, or TIC, and what they show is quite a lot that we expected, and some things that lead us to eventually explaining why the franc is doing what it's doing, why the monetary system is on edge. But first, it does suggest that I got something wrong where it comes to the events, the deflationary conditions in April. I said that the Treasury market sell-off was triggered in large part by foreign reserve managers who were responding to a global dollar shortage by selling their reserve assets and using the proceeds to deal with that shortage. According to the tick data, that not so much. The Treasury Department statistics on foreign official selling actually doesn't show net selling at all in April. Now, that doesn't mean there wasn't any selling. It just wasn't as likely a significant factor. Not as significant as I thought it had been. Instead, that was mostly basis trading hedge funds, who were by far the biggest reason for Treasury yields rising back then. And if that's the case, that means the same thing regardless, which is a mess in global repo. And that's where the tick data comes in and does confirm the repo market, the funding market as a whole across the Eurodollar system in April, not surprisingly, was indeed a big mess. But it goes even farther than that into the realm of shadow banking. But before we get to the shadow banks, we've got to talk about tick and what it actually shows. What we're going to start with is something called resales, and I've talked about this before. This is where U.S. banks lend cash on a collateralized basis to overseas borrowers. It's called a resale because the data takes the perspective of U.S. banks. And U.S. banks do include domestic branches of foreign parents. So if a repo is when someone borrows cash, from the perspective of a cash lender, a resale is when they lend. It's also called reverse repo, but Tick categorizes it as a resale. So as I've shown in those prior videos, resales rise significantly during deflationary periods. And what that means is when the circulation of funding around the rest of the Eurodollar world dries up, offshore dollar borrowers look to these U.S. banks as sort of a lender of last resort. Not the Fed, U.S. banks, and primarily dealer banks. And by dealer banks, I don't necessarily mean primary dealers, but money dealer banks. Now, since the start of this year, according to Tick, resales have absolutely soared, especially in January, but rising $348 billion, or a whopping 21% in the 4 months of 2025 up through April. That's not good. As we've seen throughout history, rising resales is not a good sign. And in April alone, the Tick data shows a $91 billion increase in U.S. resales. That matches the intensity of the crisis that unfolded back 2 months ago. So already we've got confirmation of what we thought all along, that the repo market was indeed experiencing a massive mess. The entire Eurodollar wholesale funding network was having a huge problem of the kind that would lead hedge fund basis traders to do what they did, to get out of repo before it turned into a big loss for them. But having established that, we now have to look at what was coming back. Now, Tick doesn't give us the full picture on the collateral side, but it does give us part of it, and probably enough of a part of it for our purposes here. On the other side of a resale, which again is a claim on foreign dollars, is the collateral and the obligation to return it. So what Tick shows us as collateral coming back is a U.S. bank liability or a payable to some foreign counterparty. So where the resale shows the cash side, the payable to shows the collateral side coming in. Now, the Tick figures don't match up resales and collateral because there can be a number of different kinds of collateral that might be used to secure resale funding. Tick really only sticks to Treasury Capital, which is, it's in the name of the report, Tick, Treasury International Capital. So we can see, however, we do see Treasury bills because the Tick data does break those out. So what we find throughout history is that cash lenders in the United States, these dealer banks, during these most intense deflationary periods like 2008 or 2020, they will demand more Treasury bills and do so almost exclusively, which is just plain common sense. If the world is melting down, the last thing you want to do is lend on a secured basis that's secured by a lot of questionable collateral, in fact, junk collateral. During meltdowns, there's something similar. No one wants bad collateral. They don't want questionable values. They don't want unreliable liquidity in their security. So when the going gets tough, repo lenders want to get as far away as they can from junk. So all that makes sense. The world is melting down. U.S. bank dealers come riding to the rescue in repo. They want to protect themselves. And so they largely say, hey, we've got cash to bail you out, but we're going to need some safe collateral coming back from you. But here's the thing about April. The Tick data shows it wasn't secured by Treasury bills. So whereas U.S. banks were bailing out the rest of the world with a huge increase in resales and funding to the offshore parts of the marketplace, They were not getting treasury bills coming back during the meltdown. So technically what the tick figures show is the amount of short-term treasury collateral that was payable to overseas counterparties by US banks, they actually declined in April. It wasn't a huge drop, but it was still a sizable minus 12 billion. So we have to ask, why didn't it soar with resale activity during what was a clear deflationary liquidation outbreak? Remember, resales jumped by a whopping 91 billion in April, but yet now the tick data says the collateral coming back was less treasury bills? What the hell is going on here? We do have another piece of the puzzle that we need to address that tick does help us sort out. Who was it that was on the other side emergency borrowing in offshore repo, emergency borrowing of cash in offshore repo? Well, according to the tick figures, U.S. bank claims on the Cayman Islands and the rest of the Caribbean likewise soared, and by nearly the same amounts. So U.S. bank claims, which means loans, short-term loans to these offshore counterparties in the Caribbean, those rose by 83.6 billion in April and 291.6 billion year-to-date through 2025. So very similar proportions to the rise in resale activity, which means the vast majority of this emergency funding through global repo went to bail out entities of some kind in the Caribbean and the Cayman Islands, which we know who those are. Those are the shadow bank investment funds. So we have an incomplete picture. That's where we start. But I mean, that's the nature of the Eurodollar black hole to begin with. But even so, given the data, given what we already know from market behavior and changes in prices and curves and everything else, what we can reasonably piece together is that shadow banks got into significant funding trouble in early April and even before early April, as the rest of the Eurodollar world began to pull back from them and their riskier recent activity, including the explosion in lending from them the past year on questionable, overly optimistic assumptions that are being disproven here in 2025. So shadow banks, after experiencing that pullback in funding, that difficulties in funding, they naturally went to the lender of last resort and secured financing from these money dealers, and probably not on the best terms. So before April, what the tick data shows is that the dealers said we're going to need T-bill collateral coming back rather than junk. But when things really got bad, when the feces hit the fan blades, suddenly the dealers were willing to accept something other than treasury bills, which strongly implies that dealers took the junk instead. So you have to ask the question, why would they lend in a deflationary meltdown near emergency condition on bad and questionable collateral? The only answer we have here is they felt they had no other choice. The only other option would have been to let these shadow banks suffer the consequences and maybe even fail. So the most likely reason they didn't do that, they took the junk collateral anyway, is that these regulated US banks and these money dealers, they feared the blowback would be too much on them. After all, even as I said before, even bank regulators around the world have been warning about the exposure, the overexposure of regulated banks to shadow banks. So the regulated banks and these money dealers, they bailed out the offshore shadow banks, which caused them to take on enormous further risk on this junk collateral, whose prices, you might remember, were plummeting. That's why credit spreads were blowing out as much as they were, with the dealers betting the whole thing would hopefully subside before it went too far. So just from that, you can start to see why the market would be on edge here in June of 2025, several months later. Because the market understands how precarious everything was back in April. So would they do it again, meaning money dealers? Having been pushed that far, staring into those less than desirable options, maybe the next time they don't take the junk collateral, they don't bail out the shadow banks. Maybe these these regulated banks, they take their chances with letting the chips fall where they may. That's the best explanation for why swap spreads or the Swiss franc haven't moved much from their April extreme. The clued-in parts of the monetary system realize there are high chances that banks will have to make that choice again, and if it gets too dicey, those banks might make a different one. So the franc is too high, but we know, the global economy is fragile and weak. It's heading in the wrong direction. We know that because just from the reaction from central bankers around the world, which is why they're all turning dovish. They're rejoining the race to the bottom. But there has to be more than that. We knew there was monetary risk beside the macro. that the April deflationary outbreak had showed the monetary system and the entire situation was far more fragile than most people realized. And the tick data does a wonderful job of filling in more of that picture and showing us just how close it came to really creating a mess and the kind of disorder that markets and the real economy fallout were not prepared to handle. Rather than going back to sleep on tariff delays like the stock market has, deep down inside the monetary system, participants remain on edge, not because of World War III or conflict in the Middle East, but because the chances of a repeat to April are way too high, and the vulnerability of the system, especially with shadow banks, that if there is a repeat of April, participants in the monetary system make different choices. As I mentioned, I've gone over the tick data before, especially focusing on resales and resales connection and close correlation with treasury yields. That's the video I've got linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.